Bitcoin has been on a roller coaster ride this year. Its prices have soared and plummeted, but what matters is the revolution it's set to cause. Some financial experts worry that it is too risky to invest in. Others are concerned that it's just a bubble. But what is it, exactly? 1. It's not a currency. Many people are mortgaging their homes to buy Bitcoin, a virtual currency that skeptics dismiss as a bunch of ones and zeros floating around the internet. But it's not just Bitcoin that's soaring in value. The prices of other digital currencies have also been on a white-knuckle ride this year. Cryptocurrencies are a new asset class and, like any other investment, they can lose value. But it's dangerous to compare them to traditional stocks and bonds because cryptocurrencies are not assets but rather digital commodities that react violently to rumors, investor demand and even changes in supply. The reason it's so hard to know what's causing the price fluctuations is that the mechanics behind Bitcoin are complex and still mostly unknown. As a result, it is not possible to make the kind of educated guesses that come with more recognizable investments, such as stocks or real estate. That lack of knowledge makes the risk of investing in cryptocurrencies much higher than in more traditional assets. One of the biggest mistakes that people make is thinking they understand the technology behind Bitcoin. This is a big problem because financial people don't understand tech and social people don't understand finance, which leads to an error known as projecting your expertise, where you think you can rationally appraise the value of something that you don't really comprehend. For example, there's a pervasive belief that Bitcoin can't scale because it's too decentralized. But that argument ignores the fact that existing payment networks can handle large volumes of transactions, and the network and computers are getting better over time. It also ignores the fact that decentralization is what makes Bitcoin valuable, and that decentralization should be preserved. And, of course, it overlooks the fact that Bitcoin is too volatile to use. It's not the kind of money you want to use when its value can swing dramatically from one day to the next. Bitcoin lost 40% of its value in a 44-day period this spring. In comparison, stable coins like Tether and the USD coin have a 1/20th of that volatility. 2. It's not a security. In its most basic form, Bitcoin is a medium of exchange that allows people to swap one thing for another without the interference of a third party. It's a digital version of money, but it also can function like a store of value and even be used as an investment asset. That's why some experts believe it has the potential to eventually become a global reserve currency. That said, Bitcoin's irrational price surge has left many doubting whether it has real-world utility. The cryptocurrency is still too difficult to use for everyday transactions, despite efforts by some governments and companies, including J.P. Morgan Chase & Co. CEO Jamie Dimon, to make it more accessible. Some observers compare its prices to tulip mania in the 1600s, when bulbs of that flower cost fortunes. The fact that cryptocurrencies are often traded on private exchanges where there's no regulation makes them risky investments. Plus, some of the technology behind them is a bit cumbersome and confusing. If you are going to invest in crypto, I would recommend a small percentage of your total portfolio, says financial advisor Douglas Bonepath. you have to be willing to hold on for the long haul. It's not just the speculative nature of some cryptos that make them high-risk investments, either. Some of them can actually be considered securities, meaning that they have been issued by a company and are being sold publicly. And that's a big deal if you plan to sell at a profit, because the IRS has rules about wash sales and how to report capital gains. Some of these altcoins, like the failed Luna crypto, which imploded in 24 hours, wiping out $40 billion of investor wealth, are essentially Ponzi schemes committing security fraud. Others, including stable coins that track the value of a traditional currency, are good candidates for passing an SEC test to qualify as securities. Most investors know that there is always the possibility of their investments tanking due to broader market events, or even more localized company-specific problems. But what many aren't aware of is that Bitcoin's volatility can be even more extreme, which is why some experts consider it closer to gambling than investing. Three, it's not a commodity. Bitcoin is a cryptocurrency, but that's not enough to describe it. It's also a digital store of value and a medium of exchange that has been decoupled from government authority. This has made it attractive to investors who want a store of value that is less vulnerable to central bank inflation and political manipulation. Some experts have compared it to commodities like gold or oil, but there's an important distinction to be made. Finite supply commodities usually have a non-financial use that drives demand and keeps prices stable. For example, gold can be used to make jewelry and oil can power cars, which creates a minimum level of demand that prevents their price from falling to zero. However, unlike those commodities, Bitcoin is not a store of value because it can't be physically manipulated or mined to produce more of it. Instead, Bitcoin's value is derived from its scarcity, which is a function of its code, not price or political pressure. It's also a medium of exchange because it allows people to send money to each other in a way that is secure and fast, and it can be used to purchase goods and services. This has created a strong market for it because it enables people to transact privately without the need for trusted intermediaries. In the long run, this will continue to drive investor demand for it. As a result, it is likely to outperform every other asset class over the long term. Despite all the hype, it's important to remember that Bitcoin is still a relatively new and volatile asset. It's not for everyone, and if you are not comfortable with its volatility, it may be best to steer clear. That said, if you are prepared to ride out the early-stage volatility, Bitcoin could provide exceptional returns in the future as it matures into a globally established store of value. So, the key is to keep a cool head and take advantage of the opportunities it offers, while avoiding the mistakes that have tripped up many other investors in the past. Four, it's not a hedge. Bitcoin proponents argue that it's not just a digital currency but also an investment. They claim that, just like gold, it's a store of value that won't lose value. They also believe that it's a hedge against inflation. This argument is flawed. The main problem with the Bitcoin is a hedge argument is that it overlooks one key fact: Bitcoin is a speculative asset. It doesn't produce earnings or pay dividends, so any returns on it rely on convincing other people to buy it from you at an even higher price than the one you paid for it. That's a dangerous proposition for any investment. But it's even more dangerous if you think about what Bitcoin actually is. Cryptocurrencies have no intrinsic value and, unlike gold, aren't backed by anything. They're simply computer code that has been manipulated to increase in value over time. And the values of cryptocurrencies aren't even stable, as they've risen and fallen far more frequently than stocks or bonds. Those price fluctuations are driven by everything from political events to the tweets of Elon Musk. This volatile market is making it difficult for anyone to use cryptocurrencies as an alternative form of payment or a means to hedge against inflation. And because the underlying blockchain technology is so complicated, it's nearly impossible to understand in its entirety. So, the best advice is to keep your money in your pocket until this frothy bubble bursts and then start looking into other investment opportunities that can provide more reliable and consistent returns. And, of course, if you're a professional investor, don't forget that your fiduciary responsibility is to put your clients' interests first. If you're interested in learning more about how cryptocurrencies can fit into your portfolio, reach out to us. We can help you understand the complex world of cryptocurrencies and create a plan that fits your unique needs. And don't forget, we offer a full range of investment products, including exchange-traded funds that can help you limit your direct exposure to Bitcoin. You can learn more about these options here.